Welcome to Stock Talk with Mike. This is part 2 of my portfolio review where I'm going to go through my 11th largest position through to my last, which is my 21st largest position. I have 21 stocks in my portfolio. If you haven't checked out part 1, you're going to want to do that, where I go through my largest position through to my 10th largest position, and I go through my review process and what I'm trying to accomplish. I like to do this review a couple times a year, and it kind of paves the way for any kind of adjustments I'm going to make in my portfolio over the next 6 months or so. These 11 through 21st are a little bit smaller positions, generally less than 5% weighting each, and that's either because I'm not done building out my position, it's not quite as high a conviction, or it's just trading really steep right now when I run the register booking in some profits in those positions. So let's get into it. All right, so starting with my 11th largest position, that is Crowdstrike, ticker CRWD, currently a 4.2% weighting in my portfolio, close to a full position size. Anything 5% or larger I consider a full position. And Crowdstrike is the endpoint cloud-based cybersecurity leader, seriously displacing all legacy-style cybersecurity companies, currently serving 63% of the Fortune 100, absolutely destroying the competition and gaining market share very quickly. And it's up 47% since my last 5-month review I did, so it's been on quite a tear as of late. This is one I've been invested in since shortly after the IPO, since around $53 or $54 a share, I believe. And I actually added on the March weakness we saw on a pullback when it reached under 200. I added some more, now currently at $262 a share. It was a heavier weighting in my portfolio, to be honest, but I actually took some profits at a higher level. Getting into that valuation, even for a cloud SaaS tech company with extremely high revenue growth of 61% expected in 2021, it's trading at 42 times expected 2021 sales, with barely eking out profitability expected, with a forward PE of 331, so astronomical PE as well. That's high any way you slice it. Definitely one of the really highly valued SaaS software tech stocks out there. So this one gets marked for red for me for a premium valuation. So even though I'm very bullish on Crowd for the long term, and I'm not going to remove it from my portfolio based on valuation alone by any means, and I think it will be a performer even at these levels over the long term, but I'm probably not going to be adding at these levels. But I also am not going to be trimming anymore, just that it is below a full position now. So this is what I'm going to hold and just kind of wait and see. And if we see some big weakness in Crowdstrike during a broader market sell-off, this kind of stock will get hit even harder if we see one. This could be one at that point I'd look to add to. Next on the list, number 12th largest holding for me is Shopify, ticker SHOP, with a 4% weight in my portfolio. It's up 40% the last 5 months, so another great performer as of late. And it's a relatively new position for me that I took in early 2021 and added shares on that weakness we saw back in March. And since then, performed extremely well. And it's still a relatively small position for me, but again, this is one that's always traded expensive. But I marked this one as red. It is very highly valued. This is one I've limped into because it's always traded expensive, but I've really liked what I've seen with the company and wanted to be a part of it. At this valuation, I wouldn't want this to be a 10% weighting my portfolio or anything like that, but I do like Shopify long term. It's currently trading at 39 times 2021 expected sales, with a forward PE of 230. So obviously extremely expensive, even given the extremely high growth rate. Next, my 13th largest position is NVTA, ticker NVTA. They are the DNA analysis for disease pre-screening. I really like NVTA as a DNA play. It's where we're going as far as early detection of various diseases. And it's currently a 3.2% weighting in my portfolio. This is another phenomenal performer. It's actually reached over 1,000% return for me on its highs at closer to $60 a share. And it's well off those highs currently, trading at 31.17 and down about 5% the last 5 months. So we've seen a little bit of a decline since I did my last review. Not bad valuation at 14 times sales at these levels. Not currently profitable. Expecting some huge revenue growth, obviously, in 2021, 73%. And it was a larger position, but this is one I've actually rung the register on and taken some profits on. And probably not adding here, but I did add recently around the $30 level already. So I would like to see a larger sell-off deeper into the 20s if I was to add more, but I could see myself growing back out this position to a bit larger. Next, number 14 in my portfolio is Disney, ticker DIS, with a 3.2% weighting. Obviously, doesn't really need much of a introduction, Disney, but I really think they're a reopening play, but in the short term. But combining that with their new digital assets that they developed through Disney Plus and whatnot and streaming, I think it could be a real powerhouse and just a great blue chip to hold for the long term. And, I can imagine at some point I could see them even reinstating the dividend. But at this time, I'm fine with them not paying a dividend and reinvesting back into the growth. I'm perfectly fine with capital appreciation through increased share price as well. That works just fine for me. Currently, I'm trading at $184.12 a share. It's pretty flat over the last 5 months, only up about 2%. And it trades reasonable, I think, based on what we're going to see coming down the road with increased revenue. So currently trading at 5.1 times 2021 sales with a forward P of 36 with a revenue growth rate of 28%. Reasonable, I think, given that I think we're going to see better numbers out of Disney as we continue to reopen here and the theme parks build back out to full capacity. So it's not a huge position in my portfolio, but I'm not necessarily looking to add. I just think it's opportunity for massive outsize returns going forward over the long term is unlikely. I just have this as a nice sort of steady Eddie stock in my portfolio that takes a little bit of risk off the table. Almost a little bit of a cash park with some appreciation on the side. All right. So these positions are starting to get a little smaller now, below 3% weighting. So these obviously are starting to have a little less impact on the overall performance of my portfolio here. Number 15 is JMIA Technologies, ticker JMIA, with a 2.9% weighting in my portfolio. They are the e-commerce player in Africa and a very interesting company that I really believe in the long-term opportunity here. This is definitely a speculative play for me. The company hasn't been executing on a really high level as far as growing revenues and increasing profit margins or anything like that. They're really still working out the challenges of logistics in working in e-commerce in Africa. And I want to be along for that ride. And I think it could be potentially huge given that it currently only has a 1.9 billion market cap and 1.1 billion book value, right? So it's not a huge company with massive potential serving 11 fast-growing countries in Africa. All right, so I've held JMIA since $4.05 a share, and it's had an incredible run. Seen some sell-off pressure as of late. The last 5 months is down 43%, but still up incredibly if you zoom out a little bit and look at a long-term chart in this thing over the last year plus. I'm trading at 10 times sales here, not currently profitable, with 2021 revenue growth sitting at only about 7%. I think it's pretty fairly valued here. I added some more recently back, and I trimmed at various levels on the way up, 30s, 40s, 50s, and 60s, as it was just such a great performer through 2020. And I'm pretty happy keeping around here, around like a 3% weighting or so in my portfolio. But if we saw continued weakness much lower, I would reevaluate adding more to JMIA again, definitely. Want to kind of keep it at least this kind of weighting in my portfolio, anywhere from 3% up to even 5% weighting in my portfolio for JMIA. I think the best days are still ahead of it. All right. Next on the list, number 16 is NVTA, ticker ENPH, solar power play, and currently a 2.67% weighting in my portfolio, and pretty flat past 5 months, up 4%. So trading kind of sideways. It traded up for a while and it's kind of come back down here to these levels. But slightly expensive at 16 times sales with a forward P of 57.3. But I'll give it a lot of leeway here as far as valuation, given the massive revenue growth of 72% expected in 2021. I'm holding here at these levels. If we saw this drop another 10, 20%, I would be adding to Enphase. I would like to see this position up to around a 5% weighting, so I could see myself doubling up on this position. Next on the list, my 17th largest position, IDEX Laboratories, ticker IDXX, the veterinary diagnostics and test kit company. The stay-at-home economy has really contributed to increased ownership of pets. People treat their pets like humans nowadays and want to provide them with the absolute best care. And that's just a great trend for IDEX Laboratories that they've been a beneficiary of. And this has been a phenomenal performer. I've owned it for a few years now, and it's up another 42% the last 5 months. This has just been a rock solid stock for the last 10, even I think 20 years. But it's starting to trade pretty expensive with this run. And I have to mark it as red here with just an 18% revenue growth rate. That's nothing to sneeze at, but it's trading at a price to sales of 18 with a forward PE of 72.9 for a well-established business with a moderate revenue growth as far as growth companies are concerned. It's expensive at these levels, but it's a relatively small position for me at 2.42. So I'm contemplating if this gets over 700 again, cashing out on this position. I can't really trim it given how small it is. It's either remove it, or add at some point. So yeah, just at these levels, I can't get behind adding more here. And I might look to get back in. Obviously, I do like this company and I've held it for quite a long time. If I did sell out of this, if we saw it back in the 700s, I'd be looking to re-enter, on the next big market sell-off, on the next cycle. Wouldn't faze me seeing this thing drop below 500 again, right? That's just the way the market works, especially with these high-flying, high-performing stocks. All right. Next on the list is Home Depot, ticker HD. So this is another blue chip staple for me, and I generally have these as relatively small positions. It just adds some stability to my portfolio. Make up for a lot of the volatility and a lot of the high-flying growth stocks that I have in my portfolio. So obviously it needs no real introduction. Obviously Home Depot performs really well during a strong housing market and when the economy is firing on all cylinders, and like we've kind of seen as of late, even through the pandemic. So it even pays a nice dividend. It's one I've held for several months now. I haven't been in it for an over long time, but it's performed quite well. It's up 9% the last 5 months, so not too bad. Trades cheap at 2.4 times 2021 sales with a forward PE currently of 21.7. I like Home Depot at these levels. I could see adding, but honestly, given this being a more blue chip company, I would see that PE fall below 19. So maybe when the stock falls below 300 or so, I could see doubling up on this position and pulling it up to around a 4% weighting or so in my portfolio. All right. Next, number 19 is Tesla, ticker TSLA. Again, another one needs no introduction. It's my 19th largest position at 1.96% weight. So very small position in Tesla. For some reason, this has been a name that I've been in and out of and never really been able to build out a position. I was a bit late to the party. It was around the 4-to-1 stock split that I first got into it, and a small position, shot right up, took profits, totally cashed out in the position. Had a big sell-off in March, got back in. It's done okay as of late, but it's still kind of a small position. I can't just bring myself really to add more. I just think despite future optionality in this company, it's really up the alley, the type of company I like to own, and future promises. I just, for currently its operations being primarily a car company, with this kind of valuation at 14 times sales and 104 forward PE, I could just see it trading relatively sideways for some time. And I'm sure at some point it's going to make that next big leg upward, but I think it's going to grow into this valuation for a bit and consolidate for a while here. So this is one, if it gets up 30 or 40% from my cost basis, I could see ringing the register in and kind of treating it, not a swing trade, but more of a short-term or medium-term investment for me. And that's why it's a small position relatively for me. All right. Next, 20th largest position currently, Redfin, real estate company that's offering a streamlined home buying process, cutting those margins, those commissions on buying real estate, offering 1% real estate fees and on selling a home, and also offering iBuying like a number of the other companies out there right now. So currently my 20 largest position at just a 1.8% weighting. This was a much larger position for me, but I did take some profits on Redfin as it was soaring high earlier in the year. And then it's seen a lot of downward pressure, seen it kind of shrink in my portfolio. But I think it's a reasonable valuation here, starting to look fairly attractive at 2.8 times sales. I'm not sure what's in the future here for the housing market, but with current revenue growth rate of 102%, the valuation is looking pretty attractive. But it's also, I forgot to mention, it's down 26% in the last 5 months, that downward pressure. So definitely seeing that downward trend, and I'm getting interested in possibly adding back to this position. All right, my smallest position, the 21st position in my portfolio is DraftKings, ticker DKNG, the sports betting, sports book, and iGaming play, really. This is one that I'd love to have a larger position in, and it's been difficult for me. It is down a little bit, down only 2% the last 5 months, been trading kind of sideways. And this is one I opened a small position in shortly after the SPAC when it shot up, I think around $39 a share or so, and it just shot straight up and never really had a chance to accumulate more shares. So if we get back, if we see some more pressure and we get back to those kind of levels I originally bought at around 39 or so, I would love to double down on this position and double up and see where it goes from there. But it trades slightly expensive here at these levels at 19.5 times sales. I mean, that's a high number. That's a high price to sales multiple, but we're talking about a company with a revenue growth rate of 110. So you give that a year to play out, and all of a sudden that price to sales ratio is dropped in half. And that's why I give these stocks a lot of leeway on valuation when they're the high growth variety. So there you have it, the 21 positions in my portfolio. Generally, I'm pretty happy with the stocks I'm holding and the allocation of each in my portfolio. But there's a few that maybe I would look to take some profits on if we can see continued strength, as I am trying to build a little bit of cash just so I have a little bit of dry powder on the sidelines to take advantage of any weakness and to add to my highest conviction stocks or those that I feel are undervalued.